Hello, I'm Greg Benal, and welcome to TD Active Trader Live, brought to you by TD Direct Investing. This is your educational one-stop shop for in-depth market analysis, investment insights, help boost your trading potential. Coming up, U.S. markets lower for a third straight day, but we're still within reach of those record highs. That has a lot of people asking what comes next. In just a few minutes' time, we're going to get the technical take from Chris Vermeulen, who will walk us through the charts and what they could mean for investors. We're also watching the U.S. dollar index under pressure this year as it slips below some key moving averages. And Lululemon, its stock cut in half on slowing sales, rising discounts. We're going to break down whether the brand can regain its footing or if the slide has a little further to go. That's all ahead. You're watching TD Active Trader Live. Half an hour into the trading day, let's get you caught up on the market. Start with the S&P 500. We're down just a little shy of a full percent right now. It has been led by tech stocks, pulling us lower. We also got some U.S. jobless claims today. They fell to 218,000. That was well below estimates. Remember, last week, we got a rate cut from the Fed on fears that the labor market was in need of a little bit of help, even though inflation was still sticky. So it's an interesting part of the calculus. But we get back to those concerns about the AI names. I find this really interesting, intriguing. A fear that the trade is a bit circular. Think about $100 billion going from NVIDIA to OpenAI. Of course, OpenAI needs chips from NVIDIA. A little bit concerned that the ecosystem's a little closed at this point and we've run up a little too far. A great example of this, we'll jump into the heat map and just basically show you what's happening beneath the surface right now. You do have NVIDIA, the Microsofts, the Googles, the Metas, the Amazons, the Oracles of the world, the Broadcoms, all taking substantial points off the table. Let's hone in on Oracle, the database software company, falling again today. Those worries about the AI trade continue to drag that stock lower. The Street appears to be questioning now Oracle's contracted cloud revenues. Remember when they came out with that number a couple weeks ago, the stock had a huge pop, maybe a little rethink on that. And apart from the AI trade, Lithium Americas, the mining stock, popping another 21% today, almost doubled yesterday. This was on news that the Trump administration wants to build an equity stake in the Canadian company. That's right. This is a BC-based company, dual listed though in Toronto and New York. So interesting times indeed. And that's your market update. All right, joining me now from London, Ontario, my colleague Hiran Amin from the Direct Investing team and technical analyst Chris Vermeulen, founder of the Technical Traders. Gentlemen, thanks so much for joining us today.
Thanks for having us.
Great to be back.
Before we get started with the conversation, a reminder to our viewers, the views and forecasts expressed are solely those of Chris and his team at the Technical Traders, and they're based on their research. So Chris, markets, we've had 3 down days right now, but we're not that far off of record highs. It's been an AI tech kind of rally on this end, but we're looking at, low volatility on the VIX. We're looking at record low put-call ratios. If you take a step back, where are we in the market cycle right now, and where could we be going according to the charts?
Yeah, well, I mean, if you want to look at the big cycle of the equities market, I feel like we're kind of getting close to the markets wanting to put in a pretty significant top. There's a few different reasons for that. From a high level, NVIDIA, the big techs, as you just pointed out there, Greg, they've been pulling the markets higher. The AI space, we're in this innovation and adaptation phase, which is usually something new comes to the market or to the economy, and it creates this growth, this big move. And it happens to be in AI, which happens to be the largest tech, dragging the indices up to all-time highs. But it's really not a super strong rally. In fact, if you look at equal weighted stock indices, you look at the small caps, the micro cap indexes, they are actually all slamming into resistance. So there is I have a big concern that this market might be running out of steam. We've got the whole OpenAI, NVIDIA, kind of that closed loop system. And I think it is pretty frothy. Right now, when we look at the NASDAQ, using technical analysis, the Fibonacci extensions, the NASDAQ has actually run right into resistance, an upside target. The S&P 500 has about 3% upside left. The Dow actually has about 6 or 7% upside. So it's kind of interesting. The crowded play, QQQ, feels like it's actually kind of done from a technical standpoint. And depending what the big techs do, it is going to kind of control the overall direction of the market, because big techs have lost their momentum when you look at the NASDAQ, and small caps and mid caps have all hit resistance. So the markets have some work to do. I wouldn't be surprised if the markets take a pause and trade sideways for potentially a couple of weeks to figure out if they're going to go higher, take a bit of a breather, or if they're actually going to stall out and have a bit more of a correction.
Now, Chris, as the markets try to figure that out, and obviously if people have hooked their wagons to the equity train, they've been happy with what they've seen over the last several years. How are you thinking right now about some other asset classes, whether it's currency, bonds, or some defensive assets alongside those equities right now?
Yeah, well, I think gold is one of the big global barometers of what's going on in the market. So gold has been shooting higher. We've seen really a huge influx of people piling into gold, silver, and miners, which if you were to look at like the miners or like SILJ, which is the silver miners ETF, this has gone parabolic. And same with gold miners. They have shot straight up into kind of nosebleed territory, meaning whenever a market goes parabolic, when everyone piles in and price goes straight up, usually what goes straight up wants to come straight back down shortly after. And so we're at this feeding frenzy right now of everybody who's in precious metals feels like it's going to go to the moon, and those who aren't in it right now have like massive FOMO. We hit a FOMO level on the market this week, which people is just fear of missing out, and people are diving into this space and they don't care that they're buying way up here at these high valuations. So overall, the precious metal space, gold is telling us that something is brewing behind the scenes. There could be some big news, some economic data that could turn, and gold is warning us that there's a lot of uncertainty and fear behind the scenes, and people are trying to get out of the markets, moving into a physical asset because they don't trust currencies, they don't trust governments. We're running into some very difficult times in different countries right now.
Chris, let me jump on that thought for a second, because you mentioned we're kind of in that FOMO phase right now, kind of market tops. Part of any investor would want to be is like look behind the rearview mirrors. So in terms of contrarian indicators is what I'm trying to get at. Which ones do you feel like, or when you're doing your analysis, are the most useful? Or is it gold? I know you mentioned gold, or is it, are you looking at the VIX or the put-call ratio in terms of contrarian plays there?
Yeah, there's a few things going on. So, for example, if you go back to 2007, you compare what the stock market did, what gold did, and what the dollar was doing. Just as the stock market peaked in 2007, gold and stocks were at all-time highs. The dollar was the most undervalued, most hated currency. We have the exact same setup now. You can put the charts, beside each other, and it's very similar, that situation. The other side of that is we're kind of looking at the put-call ratio, as you mentioned. It's at a very extreme low. It's been low for a couple of weeks on average, the price. And that means everybody has bought into the stock market. Now they're buying leverage. They're buying options because they're betting this market's going to go higher. And typically, when everybody just keeps buying call options, they're expecting the markets to go higher. And we're at a level now that everyone feels like it's going higher, and they're betting on it. And the VIX is low, as you also mentioned. And when the VIX is low, it's time to go, is kind of the saying. It means there's no fear, and people don't think it's going to pull back. And those are contrarian indicators. We're even seeing utility stocks outperform. They've rallied 2 days back to back, while the stock market has gone down 2 days. And it's a tiny little thing, but it tells us that money's moving to defensive sectors to try to find some safety, because they're worried about technology, they're worried about the markets. And no matter what happens in the economy, you still need running water, you still need electricity. So utilities pay a dividend, they're not going out of business, and that's why we tend to see money move to those when people start to get nervous on the short-term basis.
Yeah, what's the old adage that I love that you mentioned with the 2007 play was history often, doesn't repeat itself, but it often rhymes in this case. Now, the other thing I wanted to ask you was, so going back, so we've got very bullish charts still on the equity side of things. But at the same time, you mentioned there's a bit of a contrarian play with gold also making all-time new highs as well. So how do you reconcile that? Because typically those kind of are inversely related most of the part, or gold certainly lags if equities are rising. So what do you make of all the play and what gold is showing?
Yeah, I mean, they can go in opposite directions. If you look at the more or less a few years leading into the 2007 market top, gold and stocks rallied dramatically together. And we've seen the same thing for the last couple of years with gold and stocks right now. So they're not always the opposite. But the thing is, you need to, because relationships get broken all the time. Sometimes gold will move the same with equities. Sometimes it'll move the opposite as a defensive play. The key is to use technical analysis to follow price. So it really doesn't matter if they decouple or they move together. If you're just following price for each asset, then it doesn't matter where they go because you're following price. And a lot of people try to play off these relationships. Oh, if stocks go down, gold should go up. Well, that's a failing strategy. You're better to just look at gold and say, hey, if gold is trending up, I want to own it. If stocks are trending up, I want to own it. In fact, we are long the stock indices right now, and we're long gold, and we've been long them for a little while, and they just keep pushing higher. So you really kind of have to throw those relationships somewhat out the window. You really do need to follow price as a trader, as an investor. We're here to make money. If something isn't going up, you don't want to hold it. If it's going up and it's something you like, you should hold it. And that's the key, is find something in an uptrend and follow that trend. Don't let the news or your bias get in the way, or these relationships that sometimes happen and sometimes don't.
Chris, we know that sentiment is a powerful force in the markets. I understand that you have your own sentiment indicator. Well, I'm curious, what goes into it and how do you use it to time your moves in the market?
Yeah, so just as important as price action is, because we do want to follow price, sentiment is just as important. So I've created this more so custom indicator that allows us to get a feel of the market. So most people look at the markets from a very flat level. They look at price action or they look at fundamental. What I look at is price and time and sentiment. So if you take that, then we're looking at the markets from 3 dimensions. Not only is price trending up, and we want to know if it's in an uptrend or a downtrend, but as you can see on that chart on the right-hand side, there's these color-coded bars of orange, red, green, different shades. This is telling us the sentiment, the money flows in the markets. And so this is telling us where money is flowing between about 12 different asset classes and sectors, between risk-on sectors and risk-off, defensive, like bonds, utilities are kind of risk-off. When people get nervous, they want to tend to move to those. Same with gold. And so that sentiment chart is telling us right now on the hard right edge is that the market is nervous. There's actually big money moving out of this market right now. The big techs have been dragging things up. And we need to be aware, the last time the market gave us this signal where the sentiment is orange and red, utilities are starting to lead the way, gold's performing well, we had news hit, which were tariffs, and the market fell about 20%. So the markets right now are antsy. They can sense something's coming. There's big money. When you lift the hood to the market, there's big money flowing out of risky stocks. And that, I think, has to do with a lot of stocks running into resistance, and savvy money is trying to be defensive right now. So that's how I look at things.
Okay. Chris, we're going to get in a little bit of the technicals here for a moment, because you said, you're long equities and you're a big proponent of using moving averages. Specifically, you look at the 5 and 20 day. So can you just walk us through that? Tell me how that plays into your trading and portfolio management.
Yeah, so one of the most prominent kind of cycles in the stock market is more or less a 20-day cycle. So the easiest way to see that, if you don't have cycle analysis tools, is just the moving average. A 20 and 5-day exponential moving average are what I use. And more or less, if the 20-day moving average is sloping up and the 5-day moving average is above it, and price is above both of those, then you're in a nice strong uptrend. And so as long as the 5 days above the 20-day and they're all sloping up, you want to be holding stocks. We're in a nice wave rolling through the stock market. But when the 5-day crosses below the 20-day, you really need to be defensive. You should be looking to protect your capital, because we could go into a multi-week pullback or pause in price. And really, those are the 2 best tools, those 2 moving averages, just to know, are we in a rising market or a falling market environment? When the trend is up in the stock market, you can almost throw darts. It really doesn't matter. It's kind of like the ocean. When the tide goes up, it lifts all boats. The stock market is pretty much the same. If you're in a rising tide, go find the stocks and sectors you like, and then you can take advantage of those when they have breakouts and moves. And when the market is in a downtrend, you really probably don't want to be holding assets or equities, because on average, they're going to go down and get pulled down with the equities market as a whole.
Okay. Chris, before we let you go, sorry.
Yeah,
you got something there, Aaron?
Greg.
I was going to say, before I let you go, I was just curious. I mean, you talked about FOMO, fear of missing out, earlier. You're talking about the warning signs you're seeing in the market. What's the biggest mistakes investors can make during a crowded bull market?
I think the biggest problem I always see when I'm speaking to investors is their emotions always get in the way. They get too many opinions, and it's very easy to get scared. People tend to not follow rules. They don't have a strategy, right? They really shoot from the hip. They let emotions get in their way. They skip trades. They don't get out of trades. I think the biggest thing is to make sure you have a strategy. You need to know why you're getting in. You need to know where your stop is and why, and where your profit targets are. And you also need to have a strategy to know when does that trend come to an end? When should I just close it out because it's run out of steam? And having strategy is number one. And number two is you have to have the discipline. You have to lock in profits. You have to get out when it backfires and doesn't work. You have to take a loss, or else things could turn into something much deeper and do damage. So the biggest thing is to have a strategy and then have the discipline to follow it. And typically, if the market is in an uptrend, like we keep having these new buy signals, it's hard to get in because you think that stocks are overvalued and you're like, I feel like the markets are correcting, but you still need to follow the money. You need to follow the trend. Even though the markets are signaling, hey, we should see a little bit of short-term weakness, they can still keep going higher. I mean, that's just, you don't want to fight the market or the trends. And so following the trend is kind of that third thing once you have the first two figured out.
Chris, a lot of great insights there. Real pleasure having you on the program. I hope you join us again sometime soon.
Thanks, Greg. Appreciate it.
Yeah. That was Chris Vermeulen, founder of Technical Traders. And just a reminder to our viewers that the securities and strategies discussed on our show are for educational purposes only, should not be considered investment advice or buy, sell, or hold recommendations. Here, and Chris did a number of really fascinating things there. Obviously, the market has been watching gold for a long time now. I think a record run in the precious metal can get people excited. So I really sort of like piqued my interest when Chris said, you got to remember, this record run on the gold could be warning us about something that's going on out there.
Yeah, it's that big flashing siren, right? That's lingering on there. So he obviously said he's still got exposure to gold and equities both. But the other point that he made, Greg, was important. Was we think about the market tops. It's really just the AI plays that have just been pulling the entire market up. And as there's little fractures that start happening, or it's priced to perfection essentially. And if that perfection starts being a little bit more frothy or hazy, then we start seeing those pullbacks. But the other one to keep an eye on, Greg, at the same time is the utilities. That's the biggest defensive play. So we're seeing more and more flows into utilities. We know the market's now positioning for or bracing itself possibly for a little bit of a pull down or pull back there.
All right, fascinating discussion to start the show. If you at home have a question for our guest or team, here's how you can get in touch with us. Just email td.activetraderlive@td.com. And for more information about the Active Trader platform, scan that QR code on the bottom right-hand side of your screen. It's going to take you to our TD Active Trader Live website, where you can try out the platform risk-free by opening a practice account. You just click on Try TD Active Trader, that button right there. And then when you're ready to switch to a live account, simply export your workspace, start trading for real. All right, now for more technical take on what's happening in the markets, Hiran, what are you focused on right now?
All right, Greg, we're looking at the U.S. greenback, of course. Hashtag, or I shouldn't say hashtag, $DXY is what we're looking at. We're not tweeting here or anything like that. But it's got me still hooked, because what you've seen is we've had the announcement of the rate cuts that happened last week, of course. The dollar did pull back on that announcement, but it's actually bounced off since that time. And I've got the chart pulled up, and I've actually marked it up. So this was the rate cut announcement, the FOMC last week. We saw the pullback happen. It broke below this. What has been a significant, or at least recently, short to intermediate support level at this 97.50. But since that pullback, we've had a number of these green candles coming through and breaking. Now, what's actually interesting as well is we've been in a downtrend. It's no surprise there. The greenbacks pull back. It was at the 106 level, broke through the 103 level, which was previous support, and now it's resistance, pull back below the 100 level, which is a very key, significant level historically. Now, we're still below that, but in this short-term downtrend, we've also formed like what's essentially a bit of a descending triangle. And what we're looking for is a bit of a contrarian move over here, because typically with descending triangles, you see the breakdown happen, which it did, but now it's actually broken above it. But when we talk about the moving averages, we've got just a little bit of a intermediate moving average. We've got the 21-day and the 50-day. It hasn't really stayed above the 50-day for a while, since like early August, but it has just peaked above that 50-day. What I do want to see going forward now is just to see if we can retest on that 50-day and stay above this descending triangle, to just ensure that we're going to inch towards our 150-day or 200-day moving average, getting closer to that $100 level coming into this. So there is, analysts are stating that while there is uncertainty, of course, there's possibly a move, the greenback strengthening coming into the next few months there, that we should see end of the year, maybe early into next year.
All right, great chart work on the dollar, because I've been having conversations with Kevin Hebner of TD Epic saying first you get your dollar strategy in place, and then you have to realize it means things for Canadian investors and their portfolios invested in U.S. equities. So a great breakdown on that one. You got another name here. I'm not familiar. FactSet Research Systems. What's going on here?
Yeah, this one is it's an interesting one because why I wanted to look at this was it's actually it's part of they provide research to investors essentially, a lot to institutional side, a lot to as well as retail. But Greg, commonly when we give those consensus estimates, there's different research company that gives those consensus estimates. FactSet is one of those ones that does it. So it's in line with the S&P that also does it. Morningstar also does something similar as well. So they're in that space over here. Now, notably why I wanted to look at FactSet, I've got the chart pulled up here. It's the weekly chart I'm looking at. And the reason why I'm going weekly, I had to zoom out because it had a bit of a seismic drop here. In fact, it's had this biggest weekly drop. You can see this big bearish candle here. That was right on its earnings, of course. Biggest drop since 2000. That we had, and the big thing that was that we saw this big sort of sell-off happen for was two things. One, it missed on the earnings expectation, not by a huge margin by any means. EPS came in at 405. It was expected 413, but it was the guidance. They lowered the guidance significantly, almost to the tune of about 25% on what they were previously estimating. So its midpoint right now is at 1725 for full year, full upcoming fiscal 2026 for them. So this is one to look at. Now, we've also had a number of different analysts that are covering this security. UBS, still average analyst price target is 400. UBS even said, they believe that the sell-off or the earnings reaction was excessive. And so the levels that I'm looking at just on this low, because again, we've hit lows going back. The support is 300. We haven't hit this since this is the last time we crossed it was back in 2021 when we hit those levels for FactSet. It's been really range bound for the last few years, staying within that 390 to 490, $100 range play. So this is quite a significant move that we're seeing over here. One thing to look at is to see if it can capture and break above the 300. Right now, it is. I wouldn't quite call it resistance because we haven't seen it. Confirm that move. So what we want to see is we wanted to reject off of this level and go and have some further pressure to the downside where we know the support level now has become resistance over here. Now, one other thing I've noted is I've got a double top pattern formed over here, Greg. This is a bearish pattern, of course. So what this signals is if we have a break below the neckline typically, which is 390, which we did, of course, what's the exact measured move until we see probably a little bit of an upside? So the measured move is coming out just below that 300 level. We just kind of hit it there on the conservative side. We probably have another $20, $30 on the downside before we might see some more supply or demand, I should say, step into the picture.
As soon as you started talking about it, I said, oh, FactSet. I've been using those numbers for years in my job. It was the research systems that threw me. For some reason, that made me think about rockets. So Lululemon is just Lululemon still, right? Not Lululemon Research Systems.
Still Lululemon, as far as I know, yeah. Great.
I know what they're all about. Show us the charts.
Yeah. Let's talk about chips to athletic leisure wear. Lululemon. It's been obviously famous for the yoga wear. Of course, they've had a bit of a torrid year so far, to say the least. So I've got the chart pulled up. This is the daily chart that we're looking at on Lulu now. I've had to kind of zoom out quite a bit on the price action because the stock just heading into this year was trading closer to that 400 range. We saw a symmetrical triangle pattern that was emerging at that time. What this pattern it really indicates to us is it could be either a continuation pattern or a reversal pattern. What this means is if it's a reversal, it really depends on where it's breaking to. Is it breaking to the upside or the downside? We had it to the downside. Now, what was the real catalyst was this big earnings play here. We did have a significant earnings drop start in that March period. I think this was their Q2. And then in the Q3, this is the big drop. We saw a little bit of a rally coming off of after those tariff lows. And then we had the rally topple off at that 300 level, and then we had this big drop. This, in fact, I've got it marked here. This is the 20% drop, is their biggest earnings drop in the last 5-year history. Now, where are we in this moment in time? Well, we've had another earnings that came out. We had another drop. This is below a significant level of 200. So now this is now acting as upper head resistance over here. We did bounce off this 160 support. So this is now the key levels to look at. It has recaptured back its 21-day moving average, and the momentum indicators, RSI, and at least RSI is pointing to at least a bullish momentum or supporting the bullish move so far. However, we haven't seen the signal quite come through on the MACD because although the MACD line is crossed above the signal line, It hasn't crossed above the zero line, which is really gives us further confirmation that this momentum is going to continue and an inch towards that 200 level potentially.
All right, great chart work as always, Kieran. And now you're going to walk us through a couple of ways we could trade Netflix. But before you get started, just wanted to remind our viewers that options trading carries high risk. Man, Lulu, we just talked about Lululemon, didn't we?
We just did, Greg.
Oh, there's a saying in our industry here, and trust the prompter until you cannot trust the prompter. You're going to walk through a couple ways we could trade Lululemon. But before you get started on Lululemon, just want to remind our viewers that options trading carries high risk, may not suit all investors. Significant losses are possible. So it's important to assess your own risk tolerance. Make sure you do your own due diligence before engaging in trading. Take us through it, my friend.
Yeah, let's go for it. So when you're looking at Lulu, it's been very directional this year. Like it's been in a significant downtrend by all means. But if you really are looking to see if the charts are supporting a bounce, let's start with the bullish trade over here. I'm going to just bring this up on my charts, just switch it for a second, and we'll just expand this out a little bit here. So what we're looking at, Greg, over here with the charts is if you believe that there's a bounce on offer here, and we're going to target that upper head resistance, we marked it at that 200 to 205 level. One way you could play it is by putting on a bull call spread strategy. Now, what a bull call spread strategy, of course, is it's two legs in which we are looking for directionality, of course, to the upside. So we're looking to buy a call. So in this case, we're going pretty much right at the money, which is the 175 strike in this case. We're going to go a little bit farther out in the distance. When we look at our time frame, we're looking at 85 days to expiry. So this is the December cycle we're looking at. We want time on our side because we don't want that, the effect of what they call it theta, where you lose time value on an option as you get closer to expiry. So this way, it gives us a little time to get or have the move happen. Now, the move is, what we're selling on the other side of it is going to be the 200, where we think potentially, based on the charts, where it may run into some resistance there and we might see a rejection off there. So that would complete the upside move if it does happen. It is a $25 wide spread. Now, the reason, one other point I'll make, Greg, when it comes to doing spreads is it reduces the overall cost. When you think about trading options, it's all about risk management. And if you just look at buying a solo or single call alone, it can be quite costly. But by selling on the other side of it, you're reducing that cost overall. So this trade right now is the premium is about $10 or so. So break-even wise, we're looking at least 185 to get us break even and make our money back. On the profit side, of course, anything above that and inching right towards that 200, if it touches that level, that's when we make max profit on this trade. And it's just the difference between the spread, which is $25, minus if we end up paying the $10, which will be $15 in profit on this trade.
Doesn't go your way. Is it the spread that's at risk here?
Yeah, it's not necessarily the spread, because the great thing about this is we're long the debit, so it's only just the cost. It's not the width of the spread itself. So in this case, if we end up saying that we are going to be spending or putting a debit of $10 or on the spread, then that's what we stand to lose. And that's going to happen is if it doesn't happen. Remember, it's a directionality trade. We want it to go one direction, so that's the risk. If it doesn't, if it goes in the other direction, of course, and we hold this closer to expiry, we're going to be out that premium that we put on for the trade.
All right, what if you have a different view of the stock? What's another way to play it through options?
All right, if you're going to go with what the charts are showing, with the way the moves are happening, with the moving averages, and that's the bearish play. If you think there's further downside still on offer, and I wanted to just map this out because we've hit a point at which this price level, we actually haven't seen it since just at the onset of COVID. So we're talking about March 2020 over here. At that time when we had that big sell-off in the markets, you know those days, Greg, you remember those days where we were having $1,500 or 1,500 point drops on the Dow taking place? I'm talking about that week. And so Lululemon's actually reached basically the price level that it was at during that time. But there is the lowest point that it wicked through on that candle back in March of 2020 was the 130, and this is a significant level, which is why I've marked it down. So if you're looking for a bearish play to the downside and expecting that, you know, there's further pressure coming into this next earnings that we have in sort of early December here, then you could look at doing, again, another directional on the bearish side, and this is going to be putting on a bear put spread strategy. So very similar, just the opposite effect. So what we're doing here is we're looking to buy the 170 strike in this case, just slightly away from the at the money strike right now. It's again the same cycle, December. Again, we want time on our sides for this. This time we're going to go a little bit wider on the spread. We're going 30 points wide just to see if we can get closer and capture this level that's been identified historically, and look to sell the 140 strike put there. So in all, this is collecting us just shy of $10. So it's about $9.50 right now is what he was quoting just before the start of the show. So what we're looking for the downside move here is just to take that premium minus our strike price. So our break even is going to be roughly at that 161 level is where we need the stock to at least get to get us back our money. And then any further move beyond that, going towards the 140 is when we start getting our max profit level. In this case, it's the spread, which is $30 minus what we're paying, which is $9 and change. So we're looking at about roughly $21 in profit if it does end up getting to this level of 140.
Now, on the Tuesday show, another point, I can't remember if it was you or Jason brought up, and it was an important one, that, of course, when you're taking part in these options trades, you can always close them out if they're not doing what you want them to do.
Exactly. Yeah, that's a great point, Greg. So this is the reason why I've actually mapped this out, because whenever you're doing, when you're doing strategies and you're choosing your duration, one thing is you obviously want to mitigate some of the factors that are going to work against you, in this case, time. But there's a big one right here that I've got in red, and that's earnings. Typically, what you have leading into earnings, of course, is volatility expansion, especially when the VIX is low and leading into earnings, we might see volatility pick up, which might aid us. But also, it doesn't always mean that we have to trade through those periods, but also this expires 19 December. It doesn't mean I have to hold it all the way. And this is what Chris had mentioned: stick to your strategies, respect your stop losses, ensure that you've got those targets in place. So even though someone may say that, hey, I want to get into this trade at $10, they may want to define where they're going to exit. If on the downside, if it means that, if the spread becomes half in value and maybe I want to get out. On the upside, it could be, if I double up on my, my debit. So in other words, the 10 becomes $20, then I'm getting out at that point. And that could be well beyond, even before earnings, well beyond before the expiry date as well there, Greg.
All right, fascinating stuff as always. Thanks for that, Hiran.
My pleasure.
Goes by so fast. That's the show for this week. As always, investors should perform their own due diligence before engaging in trading. Thanks for watching.